Hey, what's going on, everyone? Christian Carter from Radius, and today I am attempting to answer a question that gets asked all the time. And that question is, how much can I borrow for a house? This is a very, very difficult question to answer, but we're going to give it a shot anyway. So when it comes to this question, we're basically going to cover 5 things. We're going to cover your income, we're going to cover credit history and score, we're going to cover DTI, which is debt to income ratio, and then we're going to cover the interest rate and the down payment. So, caveat real quick, how much can I borrow for a house? That's going to depend on your individual or your personal situation. However, these are the 5 things that we take into account, right? All right, so let's get right into it. So income. We're obviously going to look for your income, and we want that income to come from verifiable sources of income, right? So it can't be, cash under the table. There has to be a way to document it, right? And that's most of the times through pay stubs and things like that, right? So we need to be able to document the income that you have. If you do have a side job, making cash or things like that, that's great, but we can't use that as income, right? We like nice stable income, right? So we want it to be consistent for at least 2 years. Now there are ways around this, but as a general rule of thumb, we want you to be in the same line of work for at least the last 2 years, and we want that income to most likely continue 3 years in the future, right? So that's essentially, when we're looking at your income, a lot of times we look 2 years in the past and then 3 years in the future. Is this income going to continue for the most part for the next 3 years? And then self-employment, overtime, bonus. If we have any sort of thing like that, especially, overtime and bonus and things like that, we're definitely going to want to see a 2-year history of you getting that. So self-employed, overtime, bonus, not as easy as like the typical, W-2 income. But still, we can definitely use that as long as we can document it and we can show that there's a history of it. All right, so the next thing that we're going to look at is your credit history and your credit score. So when it comes to credit histories, we're going to be looking for bankruptcies, short sales, foreclosures. This is a huge one, late or missed mortgage payments. We want to make sure that you have a good credit history, right? And if you have any of these kind of negative things, bankruptcies, short sales, etc., there's going to be a certain amount of waiting period between whatever the credit event was and when you're now eligible for a mortgage, right? So that's as far as your kind of credit history looks. And then as far as your credit score, as a general rule of thumb, we like to say that a credit score of 680 or better is kind of where you want to be. However, just because if you have a credit score less than 680, that doesn't mean that you're automatically disqualified from a mortgage. For example, FHA, which is a very popular mortgage program, can go down to a 500 credit score, and then something like the VA actually has no minimum credit score. So that's credit history and credit score. All right, now on to debt to income ratio. So if you ever hear people in the mortgage business talk about DTI, that's just an acronym for debt to income ratio. And DTI gets thrown all around a lot because it is very, very important, right? So I'm not going to go too much into the weeds because I think I have a whole other video that just breaks down debt to income ratio. But DTI is a percent of your monthly income that goes towards paying your debts, right? Makes sense? We basically compare your debt to your income. Now, the lower the DTI, the better. Again, just kind of like the 680 credit score, a general rule of thumb is 43% for a DTI or lower is what we want to see, right? That's what we feel comfortable with. However, just like the credit score, it doesn't, just because you're above a 43% debt to income ratio doesn't automatically disqualify you from getting a mortgage. For example, conventional, we can go all the way up to 50% DTI. And then FHA, we can go all the way up to 55%. And then again, VA actually has no maximum debt to income ratio. All right, next up on the list. This is cool because these next 2 ones, we're going to go through some examples, all right? So interest rate. I'm sure a lot of you know this, but the higher the interest rate, the higher the monthly payment, right? And then the higher the monthly payment, the less we can qualify you for, if that makes sense. Because the higher your monthly payment is, the higher your debt to income ratio will be. So here's a quick example. Just took a 30-year mortgage, right? We've got 3 different examples at 3 different interest rates. And I just want to show you how the monthly payment is going to change at those different interest rates, right? So now this is just principal and interest. There's no real estate taxes, no homeowners insurance, no condo fees, nothing like that. This is just principal and interest. So for example, you take out a $100,000 mortgage at a 3% interest rate, right? That's going to leave you with a monthly payment of $421 a month. Now, you compare that to same loan amount, so a $100,000 mortgage at a 7% interest rate. That's going to bump up your payment to $665 a month, right? And now this is kind of an extreme example, but lastly here we have a $100,000 mortgage at 10% interest rate, and that's going to bump up your payment to $877 per month. So you can see just based off this $100,000 example how the interest rate is going to affect how much you can borrow for a house. All right, last on the list is down payment. Now, the larger the down payment, the lower your loan amount will be, which in turn will lower your debt to income ratio, which finally will help you qualify for more of a home. So the larger the down payment, the more of a home you can qualify for because we're lowering that loan amount. Again, we're going to do a quick example here. So this is a $300,000 home, right? And just for, again, we're going to use just principal and interest, so no real estate taxes, no home insurance, nothing like that. And then I used a 30-year fixed mortgage at 5%, right? Just so you get an idea. But again, we're buying a $300,000 home. In the first example, we make a 0% down payment, right? So no down payment. Our monthly payment for that $300,000 home would be $1,610 a month, right? Now let's go to a 5% down payment. So on this $300,000 home, we're making a 5% down payment. That lowers our monthly mortgage to $1,529 a month. So you can tell already that the larger the down payment, the lower your monthly mortgage is going to be, which will lower your debt to income ratio, which will help you qualify for more. Last example here, a 20% down payment on that $300,000 house will give you a monthly payment of $1,288 per month. So you can tell how that lowers. So basically, let's see, difference between like a 0% and a 20% down payment. We're talking about $400, right? And this is on a 30-year mortgage at a 5% interest rate. So I hope you enjoyed this video. It's a tough question to answer. How much can I borrow for a home? It has to do with income, your credit history and score, your debt to income ratio, the interest rate that you get, and the down payment that you want to put down. So again, tough question to answer. It's going to be particular to everyone's different situation, but that's how much you can borrow for a home. I hope you like this video, and keep the questions coming. I love making these videos, and have a good one. See ya.